This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me this morning John Rubino, well-known author and publisher of the website dollarcollapse.com, and certainly no stranger. Good morning, John. Welcome back.
Morning, Gord.
Fast month goes by very quickly. As usual, there's no shortage of things to talk about.
Yeah, we've got some interesting ones this time. There've been some reports that are just shocking. Where would you like to start?
But why don't we start with the U.S. Treasuries? And that is, who is this mysterious buyer that we have in Belgium that's buying U.S. Treasuries? And the chart here shows that something happened last October or November that suddenly in Belgium, and nobody believes for a moment it's the Belgian government, but somebody's using Belgium as the place in which to buy the U.S. Treasuries. And if they hadn't bought, we would have had a serious shortfall because Russia's been selling, China hasn't been buying, and Japan hasn't. So whoever the white knight that came in absolutely saved the day. I'll speculate, John, but what's your sense of what's happening there?
Well, I think it's an interesting coincidence that just as the Federal Reserve begins to taper to buy fewer Treasury bonds going forward, somebody in Belgium steps up and basically buys almost the same amount of Treasuries. So in effect, tapering didn't happen. The buying just shifted to a different venue. So when we think about our government scaling back its purchases and supposedly tightening, we are mistaken. It's not really happening because somebody else is buying to make up for the fact that the Federal Reserve isn't buying as much debt. And that means there's just as much new currency being pumped into the system as there was in the past. And monetary policy is just as loose as it was in the past. And if anything, it's a little bit looser because of some of the other things we'll talk about here.
Exactly, John. It started in November as a fairly large spike up. We had announced taper, but we were only taking it down by $10 billion. So when we started it, actually with taper, February, March, it wasn't as obvious. So these numbers really looked distorted, this Belgian buying. But now that we're sitting here in June timeframe, the total taper reductions total about $190 billion. The total buying on this spike up totals $186 billion. So if you waited over a period of time, it's pretty darn close, which means they could have been front running it or whatever.
Yeah, the early buying had to be bigger to offset the psychological effects on the marketplace of the announcement of tapering, because just the idea that the government was going to start to taper scared the markets. And so you needed extra bond buying at that point to calm everybody down. And that's exactly what we got. And so tapering, from a psychological, market forecasting point of view was a non-event. It didn't make any difference to the markets.
Exactly, John. That's kind of my sense of it too. You know, there's 5 options that people have speculated it could be, whether it's the Federal Reserve that actually initiated, but whether they executed or whether it was the U.S. Treasury that did it. A lot of speculation that it was the ECB that was doing it because of Draghi's policy of wanting to drive down the euro and using bond buying to do it, the same as, China's done and Japan's done for years to make themselves more competitive. And, the ECB facing, matter of fact, the CEPR is saying they never left the recession, and in fact they've stayed in it. So what are we at? Eight quarters in a row of recession in EU. They just out the other day. Or whether it was China. Because, John, if you really looked at last November, China had a huge issue. In that all of a sudden the yuan was appreciating in value and spiking up. And why that's so critical is that capital investment in China is central to its GDP growth. As big as its exports are, and we know how big theirs are, they have a huge import too to support that manufacturing. And so the net of it, when you look at GDP, pales in comparison to capital investment, and that's been slowing, and that is a big issue. And when the yuan increases, it really hurts the capital investment. So if you look at the timing, it was like they reacted very, very quickly and drove that yuan down, and they would have been facing all sorts of issues with Congress for, again, currency manipulation. But if you really looked at the initial stages from October, November through February, March, it really looked like it was the ECB or China. And it could be a possibility, John, that it was a bit of a combination of everything we're talking about. And with this big deal that China and Russia were putting together for gas and oil, but gas for 30 years to ship into China and denominating it in other than the U.S. dollar. And at the last minute, it turns out, at least initially, some of the shipments are going to be in U.S. dollars. This may actually all tie together. I'm sure we'll never know, but clearly there's a lot of manipulation going on in the markets right now. The other thing that's surfacing right now is the amount of equities that the central banks and their sovereign wealth fund and public institutions within various countries are now buying in terms of equity markets.
Yeah, I think this is an even bigger part of the story here. And let's put government buying of equities into context here, because say a decade ago, there was speculation about things the governments of the world might end up doing in order to deal with the debt they were taking on. And they were generally crazy kinds of speculation, like debt monetization. For instance, QE was this experimental thing that the governments had never tried on a vast scale before, and they wouldn't do it probably. But then they went and they did it, and then it became normal. We just kind of take QE for granted without realizing that it was considered basically a radical policy at one time. And then zero interest rates, same thing. That's the kind of thing that only really aggressive, speculative analysts ever actually expected to happen. And then we went from zero interest rates to negative interest rates, even more extreme, more experimental. And now probably the final piece of this crazy puzzle is governments buying equities. This is something that having governments do on a vast scale is so far out in left field from the standpoint of commonly practiced economic policy that I think most people would have said that it's never going to happen, and it's just too extreme a policy for governments to engage in. And now we're seeing it, and we're seeing it on not just a small scale, but on a scale of trillions and trillions of dollars. It started with sovereign wealth funds, which are sort of like hedge funds run by governments, where they take some of their foreign exchange reserves or whatever, and they fund investments that way. But now it's central banks and government-run pension plans that used to invest in lots of bonds being told to dump the bonds and start buying equities. And that's probably a big part of the equity bull market globally right now, with government money flowing in to replace the smart money that's bailing out. Corporate insiders are selling their shares, and hedge funds are getting out, and now you got the ultimate dumb money, governments, getting into the equity market.
Well said, the ultimate, because institutions have been selling, the smart money's been leaving, breadth is down, volumes are down, yet the market keeps on going up. And, so there's 400, at least according to the Financial Times, 400 public sector institutions that have been buying, spread out over 162 countries. But, the People's Bank of China is by far the largest, and clearly they're a dominant one. But you got Denmark and Switzerland also buying.
Yeah, and you have to understand how indiscriminate these guys are, because they've been ordered by their governments to buy equities. And so they're not analysts who are trying to find undervalued stocks or anything. They're just going in and buying indexes. They'll buy the 100 biggest companies by market cap, or the 1,000 biggest, or whatever. And so that has the effect of distorting equity prices by pouring money into these stocks that are already way up. The biggest stocks in the global stock markets are mostly overvalued by historical standards already. And yet you're seeing this new inflow of money that really doesn't care about these valuations. They've just been ordered to buy stocks. They don't know what's overvalued and what's undervalued. These guys are bankers. They're not equity analysts, and they're not money managers.
Then you got another element of it, John. Those that are paid to manage money and should know. And let's pick on pension plans. And the biggest pension plan in the world is the Japanese pension plan. And Shinzo Abe has basically changed all the board of directors, appointed new people in charge of it, and has made it very clear to them that he expects them to move that portfolio to be buying equities, specifically the Nikkei, and to be buying foreign bonds, not domestic, but foreign bonds, therefore to drive down the yen. So they're arbitrating that you'll do it. So these people are smart enough to know where to invest, but they would say, well, this is not the strategy we had. Well, they're no longer there, and there's new political appointments that are coming in. This is financial repression, John.
Mm-hmm. Yeah, it is on a really vast scale, using what used to be thought of as experimental techniques. And the point of all of this, really, or the effect of all of this, is that it distorts market pricing. Markets normally operate by a pricing mechanism that is a signal to people within the market to do more or less of something based on how the price is moving. Well, that's not happening anymore. Now, prices are being pushed up artificially by all this public money that's flowing in. And so that distorts the pricing signals to the rest of the market, especially to individual investors. They see the stock market hitting new records and they think, wow, it's easy money. It's going up. Therefore, let me put my IRA into stocks now after, I've held off all this time because I'm too worried. And so you get a huge influx of, individual investors at the peak of these market cycles. And this is more distorted than most and is probably going to end up hurting individuals more than most previous cycles. The only one that was more damaging, I think, was the tech stock bubble, when you had everybody thinking that if they just bought Intel and held it for 20 years, they'd be rich. Now it's a little more diffuse because it's a lot of different equities going up, but it's going to have basically the same impact on all these people who are finally getting into the stock market because the government is pushing up prices and distorting, the normal market signal. So this is, in a lot of ways, it's a crime because it's funneling the wealth of working class and middle class individuals into the pockets of the super rich, who are the corporate CEOs who get paid based on their stock price, and the hedge fund guys who make a lot of money on leveraged equity bets, and the government bureaucrats who get to keep their jobs and their cushy pension plans if they generate any kind of return on the money that they're investing. So it's a huge shift of resources from people who really deserve to hold on to their money to people who don't.
The whole idea of financial repression is to move to negative real rates, which I don't think people fully understand. But by doing that through monetary policy, what happens is we get moral hazard, unintended consequences, and effectively we then get delusional in our markets. And by that I mean what happens is we start mispricing risk. And that's what we have here, is we're not correctly pricing in risk. And that's what happens when you have zero bound for this extended period of time. And so markets start to spring up. As you said, we had the dot-com bubble. We had the 2008, which was the housing bubble. And we've got this current one, which, by the way, John, I believe is bigger and more distorted than the previous two. But what happens, they all start with some basic reality. Then it gets misrepresented and starts to shift. And then it gets into pure delusional. And I think that that's the stage we're at right now, where the markets are completely disconnected. And part of this, John, is a point we were talking about before we began, is when you get equity markets this high, the yields on the stocks are terrible. In other words, the dividend payout against that stock price is just terribly poor. But then it makes bad bonds, where the yield is at historically low levels, seem even somewhat more attractive. And bonds are, as bad as they are becoming somewhat attractive. And if you believe this is the only place that you can fish in, you may see a big shift to the bond market. And that's exactly what the government needs right now, is to drive interest rates down even lower, as you have 75 million baby boomers retiring, 10,000 a day, that's going to be drawing on more money the government doesn't have and is going to have to issue it in some fashion. So you need lots of money and you need it cheap to drive down these interest rates. So there could be an orchestrated strategy going on here. John, we've got these corporate buybacks. Is that the ultimate dumb money going on?
Well, see, this is another aspect of financial repression. They've lowered interest rates to the point where it's extremely cheap for corporations to borrow money. You know, if you're a investment grade company, you can borrow money for next to nothing right now. And so companies are doing that, and they're using that cash to buy back their shares on the open market. And what this does is it artificially pushes up the price of their stock. And since a lot of their executives are paid according to how well the stock price does, it gives them a chance at a nice year-end bonus. So there's an incentive, as you said, moral hazard, you know, to behave in ways that you wouldn't normally behave, that are riskier than you would normally accept, in order to generate some kind of near-term profit, near-term gain. And we're seeing that with corporations across the board. The chart that's up now shows unprecedented buying of stock by major corporations. And they're going into debt to do this. So basically what they're doing is they're pumping up their stock price in the short run, generating some nice year-end bonuses for their executives, who will then retire and leave their successors with these over-indebted companies that aren't nearly as profitable as anybody thought they really were. And you know, the numbers are just astounding out there. Like Oracle, for instance, has capital expense of about $650 million a year. But they've been buying back $10 billion a year of their stock. And what this does is it makes the earnings look better than they would otherwise, because net earnings are spread across fewer outstanding shares. And it makes the company management look better than they would otherwise, because the stock price is higher than it would be otherwise. And spread this across corporate America and potentially the rest of the world, and you get this huge distortion in equity valuations out there. Because right now, you know, equities are being bid up while corporate debt is rising, and we haven't put the two together yet. So analysts aren't really looking at corporate balance sheets as much as they're looking at net earnings per share. And so they're inferring from rising earnings per share that these companies are well managed and they're doing great, and they extrapolate this out into the future and project higher earnings and higher share prices, and everybody's happy for now. But eventually this is going to come back to bite these corporations, because they're going to find that they owe an awful lot of money, and in the next downturn that debt is going to be this huge lead weight sitting on their backs and making it impossible for them to make the adjustments that they would normally have to make. So yet another. and corporate buybacks on this scale, that's also one of those policies that a decade ago, if we'd said that this is what we were going to see, people would have said, no, that's crazy. You know, corporations would never be able to do that. The circumstances would never make that a reasonable strategy. And yet here we are. Interest rates are so low, and the analyst community is so clueless that corporations are able to get away with this and pump up their share prices in the short run at the expense of future earnings.
I've actually found that the dumbest money has usually been corporate buybacks, John.
Yeah, Gord, because they're indiscriminate. They don't care what the share price is today. They just want to bump it up a little bit from here.
Exactly.
And because that's what their bonus is based on.
One of the biggest signs that I've always found is when you start to see this at corporate levels, you're in a market top. It's a very clear tell. 80% of all the profits of the S&P 500 on average are going into buybacks and dividends. We're talking about unprecedented distortion here, John. You know, the S&P in 2013, $475 billion in buybacks. So far in Q1, $160 billion. It's accelerating. We will have over $1 trillion in buyback in the market. You mentioned Oracle. I could talk about IBM, Apple, Cisco. They're all running rampant. John, what we also have to appreciate is when you take this many shares out of the market, that is the corporations buying, and we were talking earlier about all these sovereign wealth funds and public, they're not trading them. They're taking them out of the market, which suggests that, you know, if this keeps on, it could really spike. Comments on that?
Yeah, because what will have to happen in the future, if they want to get their balance sheets back into shape, they're going to have to issue those shares again. And so that will reverse out the effect of the buybacks, because supply will spike and prices will tank. And that will be the only thing they can do to protect their corporate viability, because their balance sheet will be so over leveraged that they'll have to issue equity at basically any price in order to pay down their debt. And yeah, you know, it just goes on and on. And so basically what we're doing in so many aspects of the global economy right now is moving future growth into the present to make the present look a little better than it would otherwise. And so eventually we're going to hit the point where we've used up all the potential growth, and we won't be able to have positive top line number. Corporate revenues won't be able to increase, and their earnings will be tanking because they'll be issuing more shares, and it's going to look much, much worse than it does today. Actually, Caterpillar, which you mentioned before we went on the air, is a really interesting case in point here. Their sales are falling, yet their earnings are increasing.
Earnings are up dramatically.
Yeah.
Yet their sales, which have been growing in Asia and China, down 30%. It's falling through the floor.
How do you do that? How do you have sales tanking while your earnings go up? And it's very hard to do because, to cut that much out of your expenses is an incredibly hard thing for a company to do that was presumably well run before that. And so what they're doing is buying back stock. They bought back $7.5 billion worth of stock last year and just announced a further $10 billion buyback for this year. So that will keep their earnings per share rising, theoretically, and make management look good. But again, they have to borrow that money. Yeah.
How long does this go on, and what stops it?
Well, it goes on until the debt burden on a lot of these companies becomes noticeable to analysts, either because the interest costs are starting to impact the P&L, or because analysts just figure out that, hey, your debt to equity has doubled in the past 3 years. That's a bad trend, and we're going to penalize you for that. And so when stock buybacks financed with debt no longer work for the share price and actually turn into be a negative, that's when it ends. That's when people get suspicious of this strategy and they start lowering the share price of companies that are pursuing it. And then all hell breaks loose because these companies will be too highly leveraged to do anything other than raise cash by selling stock. And that oversupply of stock is going to force down the price even more. So and that day's out there. That has happened in the past. And in fact, it happened in 2008, 2009. Stock buybacks spiked during the housing bubble and peaked in 2007, and then they plunged. And the reason for that is that the companies who were engaging in share buybacks weren't benefiting from it anymore because their prices were down. And nobody thought that borrowing money to buy back more depreciating shares was a good idea. And so we'll see that the same thing happen now or eventually here. And it might happen pretty soon because we're at levels, as you said, that are really unprecedented. Corporate debt is soaring. Prices are at record levels. So borrowing more to buy already overpriced shares is a very bad idea, and it's going to be shown to be a bad idea at some point in the not too distant future.
John, that famous philosopher Yogi Berra once said it's deja vu all over again, and that's what it feels like. John, we have to wrap. Any closing comments to leave with our listeners here on this?
Sure, Gord. Well, this is in a lot of ways this is a really depressing time because we're making exactly the same mistakes we made just 5 years ago. It's not like this is 1929 that we have to go back to for examples. We just have to go back to 2006, 2007 to see a lot of this stuff that we're doing today happening then, and to go back to 2008 to see it all blow up. And the market collective memory seems to be getting shorter and shorter. We just don't remember the things that happened 5 years ago that almost wiped out the global financial system because we're doing it all again. So yeah, it's an amazing thing to watch. I didn't think it was possible, and yet we have come up with, we've come up with all the old ways of screwing things up and added a few new ones. So I think the only conclusion that you can come to is that something bigger than 2008 is coming and coming quickly.
John, I sense that too. The derivatives were something that we thought we were solving with Dodd-Frank, and I'm hearing right now that the only place people can find liquidity in trading is in derivatives, and that is we're taking so many stocks off the market. There's a shortage of stocks, even though they're going up, but the liquidity and trading volumes are down. The Fed now owns 1/3 of all of the bond market, so it's withdrawn it. So there's a real shortage of these vehicles, and so when you have to find liquidity you can get that the big houses are now using is in the derivatives marketplace, and we never fixed it, as I said, with Dodd-Frank. it really says we've taken this to a whole other level.
We really have. They're pushing us.
Frightening.
They're pushing us further and further out on the risk spectrum now. Either because that's a way to siphon money away from us, or because they actually think that is a way to get the economy growing organically again. And it's on the one hand that's they're evil. On the other hand, they're clueless. I'm not sure which I would rather see happen out there. I'm not sure which worries me more.
This is the biggest experiment in history that's never been tried, obviously, as an experiment. And if it doesn't work, it could be catastrophic. We're seeing signals here that suggest things aren't working, and the degree of distortions we have, any kind of correction could be, just as we said, unprecedented. John, we have to go. Could you tell our listeners where they can learn more about your work and your writing?
Sure. I run dollarcollapse.com, and my newest book, co-written with Gold Money's James Turk, is The Money Bubble, available at dollarcollapse.com or Amazon or pretty much everywhere else.
Talk to you again next month.
Great. Thanks, Gord.
Thank you very much.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.